Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, March 6, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And we've got a lot of interesting stuff, at least I think so, to discuss tonight. So we're going to start on the daily chart and we're going to work our way down to a couple of different intraday charts. And by the time we're finished with the S&P or the SPY, one and the same, I think you're going to have a pretty good understanding of A, what I think is the larger picture, B, where I think the market is headed in the short term, and C, how we know we can be wrong, whether it's on the up or the down side. We'll start with the daily chart, and last night we discussed the fact that I thought the market would get to today 273.55, which would provide some level of resistance. We didn't quite get there. The actual high print today was 273.39, so we came up a little short, and basically that coincides with, for the most part, just a little bit of a spike through the 50-period moving average that comes in at 273.30. So we didn't quite get to my number. That's okay, not a big deal. What we are going to do is we're going to move the number up leading into tomorrow. I'm putting the number at 274.58. It could really fall anywhere in between 274.50 and 275. That's where I think the market has an opportunity to get to on Wednesday, potentially even into Thursday. But if we have any kind of upside activity in the market tomorrow, being Wednesday, I think we have an opportunity to get up to 274.5 to 275. Now let's talk a little bit about the bigger picture. Remember that I've been discussing, or at least a couple of times, I discussed that the market can actually levitate or stay buoyant at least through the third week or somewhere in and about the third week of March. I think that will turn out to be somewhat of a pivotal turning point for the market. Not 100% sure, but I think there's a high probability we can see a pivotal turning point around the third week in March. Could it be the fourth week? Yes. Could it be the end of the second week? Yes. This is an about time frame, so somewhere in the neighborhood, let's say between the 20th and the 22nd, maybe even to the end of that week, 23rd of March, which would be the week following options expiration. Now I want to show you something that somewhat supports the case that the market could banter back and forth in and around current levels, maybe slightly higher, leading into that time frame. But before I do, I want to make mention of, and I've said this many, many times, and it's gone over in detail, in great detail in my course at Lazy E-mini Trader, that time is much more important than price. There are many ways to look at time as it relates to the market, and in my course I discuss a lot of different ways that we use time to our advantage to understand why the market may find a directional change at a specific price, but more importantly, at a specific time. Traders that are paying attention to time have a distinct advantage over traders that don't understand the importance of time. A market will typically move for a certain period of time, and that applies whether it's on an intraday 10-minute chart, an hourly chart, a daily, weekly, or monthly chart. Time can be determined along with price, and when you're able to put time together with price, it gives you a distinct advantage when analyzing the markets, and you have a certain expectation of things that should happen at certain points in time. And when you see them begin to happen, you know you're on the correct side of a trade. I don't want to give away the entire secret sauce, but this is discussed in great detail in the course at Lazy E-mini Trader. Now let's talk about time as it relates to the daily chart of the S&P 500, in this case, the Spider chart. And I've drawn a couple of trend lines on the chart that I think are relevant and important. And what you'll see is these are forming a pennant or a triangle formation. You can call it anything you want. The point is that on the upside, we should be limited to the upper trend line. On the downside, we should be limited to to the lower trend line until such time as one of two things happens. Either we run out of time, in which the triangle comes to the end, meaning the peak of the triangle, or we break above or we break below these trend lines. So I think for now, on the upside, the market would be contained by the trend line in the upper portion up here. And on the downside, I think the market would be supported by the trend line going from left to right in the upward direction. So any break below that would be troubling for the market on the downside, and any break above this trend line on top would be a potential breakout, but there are certainly plenty of resistant levels up above. We've discussed them over the last several videos, one being right up here at 278.80. There's another one right up here, and this somewhat might coincide depending on when we hit this level. We have the level I cited that I think we could reach tomorrow if we have an upward day at 274.58 to 275. We have a gap window up here. We have a gap fill right above that. So there are plenty of resistant levels up top that the market would certainly find it difficult to trade through on the upside. Keep in mind, and I think this is very important to note, that I'm not the one drawing in these trend lines. The market is drawing these trend lines by virtue of where it's been and where it's stopped, whether it's on the upside or the downside. So what I mean by that is, you see, here's a pivot, and that's where we started the upper trend line. And here's a pivot, and that's where they connect. And you're connecting two pivots. So I'm connecting the pivots, but the market decided where those pivots were. And here on the downside, you have the pivot low, and then you have another pivot, and we're just connecting the trend line or drawing the trend line where the pivots existed. The market told us where the pivots were. We just connected the dots. And that's what created the triangle formation. And you can see here that I believe that when we're out of time, the market is either going to break out to the upside or down to the downside. And it's my contention that that certainly can and is likely to coincide with the point in time or the time frame just discussed, somewhere in the neighborhood of March 20th, 21st, 2nd, 3rd, in that neighborhood of time, give or take a few days on either end. Depends on when we get to the end of the triangle, but to me, it looks like that's when we're going to get to the end of the triangle, and whether we get a break up or a break down, we really don't care. We'll let the market tell us which direction it's likely headed. That's going to be the high probability trade when we break out of this triangle. Pretty slick stuff, huh? At least I think so anyway. Now we're going to take a look at the 10-minute chart, and then we're going to look at an hourly chart, and there's a reason why. So where'd the market start today? Right about here. Here's the 940 candle on a 10-minute chart. So the first 10 minutes of the trading day, the market went up and reversed. The market put in a bearish pattern and traded lower. Is there a way that somebody could have determined where the support level was going to be on the way down? Certainly, and this is obviously, or maybe not obvious, but it is obvious, this is discussed in my course. This is a bearish pattern, and this was telling us that the market was headed lower. So those that have taken my course knew this was a bearish pattern, and they knew that the direction or the pressure of the market was going to be on the downside. But that's only one of two components that you need. Number one is, if you're going to be short the market, that's fine. You have to be able to short from a pattern that tells you the market is likely headed lower. We had that. The second thing you need is, where is the target price? Where was the support likely to come in the market? Well, what I can tell you is, without giving away the total store, that this level right here, just about to the penny, or within a penny or two, was a garden variety normal retracement that we would have expected to have happen from the obvious pivot low to today's high. That was a garden variety retracement. This is right out of the course in black and white. That would have been your first support area, which would have also coincided with a target area for those that might have taken a short trade off the bearish pattern that developed right within the first hour of trading. Now let's look at a slightly bigger picture. Here's an hourly chart, and what I want to point out is that what we're doing here is we're basically trapped on top of the 50-period moving average, which is the blue trend line. We're above the 100-period moving average, and we're right below the 200-period moving average. And you can see that we're sandwiched in between there, and these are kind of converging together. The 100 is sloping up slightly, and the 200-period is sloping down slightly. And looking at it from a different perspective, we have an up move, and we're basically going sideways, and this is generally going to spell another up move coming, which is where I'm getting what I expect to be some more upward behavior, upward activity in this market, either whether it's Wednesday or Thursday. We're going to break out of this pattern one way or the other. If we break downward, and we break downward out of a bullish pattern, that's a negative for the market. And it's a little bit more of a negative than norm. It's negative to another magnitude, because when a bullish pattern fails, it will generally release the energy to the downside. When a bearish pattern fails, it releases the energy to the upside. So if this pattern fails, we would most likely get some quick downward activity in the market. Where would we know we were wrong on the bullish pattern? Well, the way I would look at it is, at least on a micro scale comparison to the larger consolidation that's taking place, you have this big green up candle. Okay, it's the standout green up candle. Has a low of 271.58. If we were to begin closing hourly, or we've closed hourly below 271.58, I would suggest that the bullish pattern is in question, which would also mean that we're closing hourly below the 100-period moving average, below an up candle, or below the low of this up candle. That would both be negative for the market, and I would suggest that if those things happened, that we were more likely to see downside activity than upward activity to the 274.58 and beyond. So from an intraday perspective, that's what I would be looking at leading into Wednesday's trading activity. Now, looking over at the IWM, which is my favorite market leading indicator on the up and the down side, we had a pretty strong day in the IWM. The IWM was up $1.66. I think it was about 1%, and therefore it was the leading market index today, along with the transports, which we'll get to in a moment. But you can see when the IWM is strong, it's my belief, it's my indication that markets will follow, whether it's strong on the upside or weak and strong on the downside. Markets will generally follow. So I'm taking a cue from the IWM today and saying I'm expecting upward behavior in the markets leading into Wednesday. You can see here's the hourly chart of the IWM. You saw the spider chart, the SPY, going sideways, building energy for a move higher in a bullish consolidation pattern. However, you can see here that the IWM was headed higher step by step throughout the trading day, finding resistance right beneath this red candle high, and that's normal common market behavior. The transports, my other favorite market leading indicator today, back to the daily chart, was also up almost 1% today, about 0.8%. So a strong showing for my two favorite market leading indicators. To me, that tells me that there's likely more upside coming in this market. Now, the transports have certainly lagged of late, so they have some catching up to do on the upside. We'll see if that has any legs tomorrow and the transports can have another strong up day. On the hourly chart, I just want to give you different looks on different charts. I think it's helpful to look at all different kinds of charts, whether it's hourly, intraday 10-minute chart, or daily, or even longer. So when you see the hourly chart of the transports, you can see what they're doing. It looks very similar to the spider chart, where we have that up candle, we're consolidating, and we're consolidating right underneath a convergence of the 50 period, which is the blue line, and the purple line, which is the 100 period. We're consolidating right underneath the convergence of those moving averages. So my question is the market consolidating sideways to build up some energy to go through those moving averages onto the upside? That's what the market or the chart is telling me. We'll see what the chart or the market has in store for us tomorrow. Now, next up, I normally will talk about gold, and I will, but first I want to point something else out. I just took a glance over, and the futures reopened after 6 p.m. Eastern Standard Time 5 p.m. Central Time, and I want to show you what's going on here. It may have an impact, obviously, on the forecast or the analysis that I just provided, which the futures, here's a 60-minute chart of the S&P E-mini futures contract. This is the June contract. Doesn't matter whether we look at June or we look at the March contract. They both look the same. Basically, the market is down, or the S&P futures are down almost 32 points right now as I make this video. Now, it's just after 6 p.m. on Tuesday evening. A lot can happen between the time the futures reopen at 6 p.m. and the market actually opens at 9:30 Eastern Time the next morning. So I'm not saying we're going to be down here. We could be down a lot farther, or we could actually be up by the time the market opens tomorrow. Something must have happened. Some type of news event must have happened. I'm not privy to it. I'm not even going to go look because it really doesn't matter. It most likely has to do with one of two things. Either it has to do with the trade topic and quote-unquote trade war that seems to be brewing in the media, or it has to do something with North Korea, or it has to do with both. Either way, it doesn't matter. My guess is it has to do with one of those two things, because those two things have been forefront in the news. However, we'll see what happens when the market opens on Wednesday morning. A lot can change overnight, as it normally does. And before we move on, just a point of interest. The bullish pattern is technically not broken until and unless on the hourly chart we close below, and we still have, as I make this video, we still have about 40 minutes to go in the initial hour of the evening session. But until and unless we close below this green candle low on an hourly basis, if we don't do that, then technically speaking, this bullish pattern is still intact. Certainly does some damage to the chart, but it's still intact. Just a point of interest. Now we'll go over and we'll take a look at the gold chart. Gold had another up day, and you remember the important number that we discussed in the gold market. As long as we can close above the high of this red candle here at 1338.40, if we can, that would be bullish for gold. And you can see where we went to today. So if I take a look at the high today, well, first, let me get the number. The high today was actually, 1339.90. So almost at 1340. And when you draw a line over, you can see here the importance of that particular red candle high. And you can see where we're trading now. So the market's trying to get above and stay above that level. And we'll see if that happens in the overnight session. If we begin closing above that hourly, that's going to be positive and bullish for the gold market. So we basically had two ideas. One is, are we going to close below this low? That would be bearish, obviously. Or are we going to be able to close above this high? That would be bullish and bring higher prices to the gold market. And the reason why I've basically stayed away from a gold trade of recent is because we're in the middle of a range. Here's the top end of the range. Here's the bottom end of the current range. We're in the middle of a range. Markets are mostly uncertain in the middle of a range unless we can identify a specific pattern that gives us a high confidence and a high probability of what the next likely move is, and we just didn't have that. So I've been telling you what I see in the gold market. I've been giving you the important numbers, but we haven't had a clear picture of a directional move that had a high probability. So with that, we may be getting that at hand now, so we'll see what happens overnight leading into Wednesday's session. Right now, gold is positive. It was positive on Tuesday. It's up slightly in the aftermarket session leading into Wednesday. We'll see if that continues. Crude oil is now back below the 50-period moving average on the daily chart leading into the electronic session and into Wednesday's session. So we'll see what happens overnight. But Tuesday, we closed above the 50 as we did on Monday. We did put in a doji candle. It's in the middle of a range, and those of you that have been with me for a while know that I'm not crazy about these doji candles, or at least the meaning or importance of them when they're in the middle of a range. When they're at the bottom on a chart or a top on a chart, different meaning to me. When they're in the middle of a range, not so much. I don't let them hold that much importance in the middle of a range. Basically, Tuesday's session closed 3 pennies above where Monday's session closed. So we didn't have anything doing other than some back and forth activity in the crude oil market on Tuesday. We'll see what happens on Wednesday. Right now, we've got a down start, down about 55 cents, but this is just getting going. We'll see what happens on Wednesday. Nothing new to report because we basically had a flat day. And with that, folks, it's everything I wanted to and intended to discuss tonight. Wednesday's session should be extremely important based on how the aftermarket session or the electronic session in the futures market started out. One thing's for sure, we're certainly not in a dull market right now. I want to thank you for tuning in for another episode of Common Sense Market Analysis. I'm David Frost. Thanks for tuning in, folks.